Good morning, good afternoon, good evening, whenever you're watching this. This is Chris Carlin here from Master Your Money Now and Vista Financial Group, just doing a final sound check for our webinar, which we're really excited about, playing the Get Out of Mortgage Jail Free card. So if you can see this, just let us know in the chat. We have limited chat to those who have subscribed only. So if you could make sure you subscribe to our YouTube channel so you can engage with us, that would be fantastic. We are going to start in about 15 minutes. So in the meantime, make sure you check us out on social media. We're on Instagram, LinkedIn, TikTok, YouTube, of course. So make sure you give us a follow as well. So give us a like, give us this video a like, put in some comments, let us know where you're from, and we will get started in approximately 12 minutes. We'll see you soon. Good morning, good afternoon, good evening, wherever you're watching this. This is Chris Carlin from Master Your Money Now, and very excited to be presenting to you playing the get out of jail mortgage jail card. What are your lending options for 2023? We'll get started in a couple of minutes. So in the meantime, make sure you hit the subscribe button so you can chat. And while you're waiting, make sure you add us on our social media channels for more content such as this. But I'm very excited today to be joined by Vista's Head of Lending and Miracle Mortgage Man, as you're referred to by someone this week. We should put that on a business card, shouldn't we, Shane? The Shane Moloney. How are you?
I'm good, thanks, Chris. And yourself?
Yeah, not too bad. Freezing cold, been in Geelong, but
we're copping it this week with these such low temperatures.
It's not good. It's not good. The heaters are blaring. At least you've got the jacket on, looking sharp. But yes, it is cold. But no, very excited for this one, aren't we?
Yeah, definitely. We've been looking forward to this for a while, and
it's very topical. I know it's a lot of concern for a lot of people, and hopefully if we can provide some options, a bit of hope, whatever it might be, to get you out of mortgage jail, then that's a win for us. So again, we'll probably get kicked off in a moment, but again, we'd love to hear your comments. Again, hit that subscribe button. Some of you might need a refresh after hitting subscribe, so you can add those comments and just let us know where you're from and what are you looking to get out of the webinar. And at any time, if you have any questions, make sure you add them to the chat, and we will get to them in due course. So yeah, like I said, it is just ticking over 12:30. And therefore, why don't we get started and talking about playing the get out of mortgage jail card? What are your lending options for 2023? Because I think it's fair to say, Shane, that despite no one really predicted 12, 18 months ago that this is where we would be. Like, we all expected rates to go up, but I don't think anyone expected them to go up this much, did they?
Yeah, look, it was quite a shock to us all in the Australian market. You know, the commentary, 12 to 18 months ago was, yes, rates will rise at some point, but it just definitely wasn't on the radar to have 12 quick rate rises in succession the way that we've experienced.
Yep.
It's left a lot of people shell-shocked, to be honest.
And it's been a lot of pain for a lot of people. So let's dive into the presentation and have a look at what we can do about it. So again, the usual disclaimers, as you can see on the screen, it's a legal requirement. We've got to do this, but again, this is what we call general advice. We don't know you. We're just talking about what you can do. If you want personal advice, i.e. what you should do, book in a chat. We'll tell you some of those options at the end of this webinar, and we can discuss your situation and go from there. So that's me. I do occasionally wear a suit. It's not that often, but I do occasionally dress up and look smart. But for those who have known me, have been following me, I've been ran Master Your Money Now for 5 years, and the young family decided that running the business was a bit too much. So we were acquired by Vista Financial Group very recently, and which enables me to just focus what I enjoy doing, which is education, which is this sort of thing, and also being a financial planner. So been around for 10 years, specialising in nurses and teachers, and we built Master Your Money Now with a real niche, focusing on millennial nurses and teachers in particular. And even though we're based in Geelong, we've got clients Australia-wide. So I guess I share all that to let you know, yeah, we understand where you're coming from. We have these conversations on a daily basis, and yeah, we certainly, I said, we obviously don't know you and your particular circumstances yet, but we've helped people in very similar situations to yourself. So who are you, Shane?
Who am I? Good question. Look, I'm what you could class as a career banker. I've spent about 25 years in the banking industry in a lot of different roles, but primarily the last 13 years as a mortgage broker, well, in the mortgage broking space, across different roles as well. But married, live on the Bellarine Peninsula with 3 young children, so hence my hair loss each year on year.
Yeah, I can relate.
Coupled with being a mortgage broker, I say that purely in jest. I love what I do. I love assisting clients in terms of, helping them either, get their property, their second property, or refinance, and improve their financial situation.
Fantastic stuff. And I know you've helped a lot of Vista clients and Master Money Now clients, and we really appreciate your help. Give us the quick 30-second spiel on who Vista Financial Group is.
Yeah, so Vista Financial Group is a long-standing established firm based out of Beaumaris in Melbourne. Principal is Tyson Roberts. Tyson has grown the business over the last few years, in particular since I've been involved with the Vista Group. So it's going from strength to strength. A real holistic approach to their clients in terms of how they service their clients. Well regarded within the financial planning industry, and now that we've incorporated mortgage broking as well, we can help even more clients.
It's a good spot in Beaumaris, isn't it?
It's a lovely spot.
Yeah.
It's a shame it takes about 2.5 hours from Geelong on peak hour traffic.
Yeah. Definitely not for during peak hour traffic. We avoid that at all costs.
That's
right. Yes, it is definitely a very good spot there. So. Anyway, that gives a bit of background. That's enough about us. Let's talk about you. So, I guess the first thing that we want to share is that I know in times like this, especially when times are tough, people do feel like, and we're hearing this all the time, that some of the things that clients are really appreciating at the moment is a bit of a reality check. And the first one is that everyone who's got a mortgage, and even those who don't have a mortgage now, whether they're renting or retired, whether that might be, everyone is really struggling at the moment. I've got clients who are on, earning over 300 grand a year, and they're feeling the pinch. I've got nurses and teachers earning 100 grand a year. They're feeling it really tight. I've got clients who've got on disability support pensions, and they're feeling it as well. So everyone is struggling. I think it's really important to share that, because I know in times like this, people feel like that you are alone and this is only just you, and it's just one of these, I'm not a psychologist, but one of these mindset things where we just get a bit internalized and just focus on just yourself. But it's just really important just to say, you are not alone. There is plenty of people in your situation, and a lot of people are struggling. And I know this feels almost like a quasi COVID lockdown 3 or 4 if you're in Melbourne. It's probably 12 that we're up to. We're now in a situation where, because of the economy, we can't go out and enjoy the things and travel that we were so looking forward to 12 months ago. But I think it's also remember that this is temporary and it shall pass as well.
Yeah, definitely. And I think if you look back historically, at the economy over the years, there have been those rough patches. GFC, for example, where people were unfortunately losing their jobs and going through that upheaval. But it does pass, and you just have to just hold tight and. That comment about just talking about it and not internalizing it, I think, is the first step in terms of getting through. That there are a lot of people in the same or similar situation.
Exactly right. Don't feel like that you have to struggle in silence. Reach out to help, and again, we'll talk about that later in the webinar, what some of your options are, and make sure that you do reach out and speak to someone about your options, because there is plenty of options that you can consider.
Yep.
So, but we're saying this will pass, but I guess this is a good segue into, we're getting our crystal ball out, the fortune telling, and I know it's Philip Lowe. Let's start here, because we're all saying, well, what's next for rates, and we'll give our 2 cents what we think. But I think it's really important to say that no one genuinely knows what's going on. And whatever you think about Philip Lowe, and look, obviously he's not the one of the not most popular persons in Australia at the moment, but you can see in that article back in 2021, right at the start of COVID, that he said he didn't expect interest rates to rise till 2024. And one of the comments in that article there, right down the bottom, is that it says that the point I want to emphasize is that for inflation to be sustainably within the 2 to 3% target range, wages growth needs to be materially higher than it is currently. Well, now the conversation's changed that we don't want higher wages, because that's pushing inflation too far. So, it is that real inconsistency. Yeah. And, we're all taking this day by day. And yes, we can make educated guesses, but realistically, no one truly knows. No one's got a crystal ball.
Yeah.
No one knows what's happening.
Yeah, and I think a lot of it is also that a lot of it's outside of our control in terms of when we look at Australia and in terms of the whole global aspect. These problems have been experienced over the worldwide.
Yes.
And if you look to America, for example, had to have a pretty aggressive rate rising cycle.
Yes.
And they're now talking about leveling off or holding for a while. So, it's. You can ask economists which way the economy is going to go. They're 50% right at the time.
That is true. And the US, that you mentioned it, actually paused their interest rate rises for the first time in 12 months last week. So, as I've said to a few of you before, my wife and in-laws are Kiwis, and whatever pain that we're feeling here is considerably worse in New Zealand, and with pretty devastating consequences there, but let's focus on Australia. Come on, Shane, get your crystal ball out. There's going to be another rate decision in first week of July. What's going to happen? How many rate rises, and when do you think they're going to start to come down?
Yeah, and look, I'll preface this is just my personal opinion.
Of course,
and
yes.
You and I talk every day about interest rates.
Yep.
And where we think that they're going to go. I think that the government or the RBA needs to look at the data, and anecdotally, the data is telling us that the economy is slowing. I read a report today that Best and Less, I don't know if you're familiar with the retail brand, Best and Less is a budget, brand. There's actually earnings have come off 13% in the last 3 months.
Wow. Yep.
So for a budget brand, a retail brand in Australia that is now starting to struggle itself, is a bit of an indication of where the economy is, is starting to falter.
Yes.
My personal belief is next rate decision, they may put it on hold because they just need that time to, to see more of that data filtering through. The evidence is out there, in my belief, that the economy is slowing. You don't want, in my opinion, they don't want to go too hard again and then tip us into potential recession.
Yeah, that's really interesting. You're a little bit more optimistic than I am, Shane, and you can go on a Google and just type in RBA space ASX. It tracks the rate tracker and what the market thinks, and at the moment it's a 50-50 whether they will rate rise or not. And I think I've said before, but is there one in April in particular where that was the one. No one expected that. The market was 0% chance of a rate rise. And I think that one was a clear message from the RBA to say, we're going to do whatever it takes to bring inflation under control. So I'm not as optimistic you are. I'm going to go on the other side of the fence and say there is going to be a rate rise in July, sadly. And I think there might be one more to go. But you're definitely right. There's definitely a lot of signs saying that the economy is slowing and these things are starting to bite. But like all these things, they're never a straight line down. There's, 2 steps down, 1 step up, 2 steps down, 1 step up. And so interpreting all that data, again, depends which way you look at it. So I hope I'm wrong. I think it does feel like the RBA will overcorrect the problem, which was what we thought they wouldn't do, but it looks like they're very clear to do that. But I'm still hanging on to my call that I made at the start of the year that there will be a rate cut before the end of the year. That's my call. And I've said that since the start of the year. Admittedly, I only said there was going to be 2 rate rises, and I think we're up to 3 or 4 now. So, but I still think there's so many people coming off fixed rates over the next 6 months, which that's when it's really going to hurt if it hasn't already. I still think there'll be a rate cut before the end of the year, and then 2024, 2025, I think there'll be quite a few rate cuts.
Look, the modelling that the government is, has to consider as well, and particularly for mortgage-stressed households. I mean, they have that data and can tell essentially, which areas will potentially be under mortgage stress. So I think that they'll be keenly looking at that data as well as to then make their decision.
There's definitely plenty of data out there, plenty of opinions, and if you've got a different opinion, let us know in the chat what your thoughts are. And we would really, really appreciate, because as we said before, I mean, if the RBA governor can't really predict where to go, I mean, we're just opinions like everyone else. So, that's what we think. And as you said before, it's out of our control. We can only focus on what we can control, which is escaping mortgage prison. So I think the first question that I want to ask you, Shane, is someone who's got the pulse on the market. When someone comes to us, they can see they open up their statement, see their rate has gone up again. What is actually a good rate for in the market at the moment?
Yeah, so we've got access as a mortgage broker and through my licensing arrangement. I've got access to over 50 lenders, so I've got a pretty good breadth of the Australian market. There's over 90 lenders in the Australian residential market, would you believe? And the big banks have 90% of that share, which is just, it just horrifies me, to be honest.
And that's not their direct shares. Like the big four banks, it's for example, Commonwealth Bank owns Bank West. I think is it NAB that owns UBank off the top of my head?
UBank.
Yep. And so it's once you factor all in, 90% sounds
that's
reasonable.
right. So when we look at the broader market, there are still some pretty good rates out there for owner occupied, as low as 5.24% for a basic product. Now that's not with an offset account. You typically pay a premium of anywhere between 10 and 15 basis points higher on those mortgage products which do have an offset account. So, but 5.24 in the market is pretty good phenomenal when you compare it to the average. The average mortgage in terms of a basic product would be around 5.85%. So there's some significant savings there.
Definitely some significant savings there. That's fantastic. So so ultimately you're saying if your mortgage starts with a 6 as things as of today, then there could be an option that there might be a better rate out there.
Oh yeah, definitely. You would be looking at that, high 5s to low 6s currently, and that's before any future rate rises. So, if we do get another couple of rate rises, you're looking at over 6.5% on your owner occupied. An investor is similar, 5.94% for an interest only investment loan.
Interest only, 5.94. What about principal interest?
So principal and interest is about 5.74. So they do discount a bit for principal and interest on investment loans. But then at the higher end, you can be looking anywhere up to 6.5%, 7% for an investment loan.
I've definitely seen a few 7s already, and if it starts with a 7, that's a huge red flag that you need to have a look at some options.
Oh, it's definitely. We just had a client that was their owner-occupied property was increasing to 7.24%, would you believe? We were able to do a discount pricing for them, and over the life of the loan has saved them $135,000. That's just
pretty phenomenal outcome. Yes, indeed. And we'll talk a little bit more about that at the moment, but what that process is. But before we do that, are banks making it easier to refinance?
Yes and no.
That's great.
Easiest question there. There's the usual criteria in terms of assessing an application by a lender, and one of the key criteria is when we're looking at refinancing. Lenders apply a 3% buffer or a stress test to the actual nominal rate of the day. So say, for example, the rate is 5.5%. They will stress test the borrower's ability to repay that loan at 8.5%. Now, what we're finding is that, unfortunately, some borrowers who got their loan maybe 2 or 3 years ago in that ultra-low rate environment are now finding it difficult to refinance because of the buffer. Some lenders, and there's about 4 or 5 currently in the market, are obviously taking into consideration of where we're at in the market and have lowered their stress test down to that buffer of only 1%. So it is making it easier for borrowers who are in that jail at the moment and can't potentially see a way out, that they can refinance to another lender.
So what does that mean practically? So obviously they're going to assess rather than say 8.5% down to 6.5%. Like, how does that make it easier to refinance?
Because the bank will look at their overall commitments, essentially, because they don't take into account just their mortgage repayment, but they'll look at living expenses as well. And any outgoings that they have, any other debt commitments as well.
So ultimately a lower service rate or actual rate means the more you can borrow.
Correct.
That's right. Which we're not talking about maximising borrowing or anything like that, but if you're looking for a better rate, you've got to service it with the new bank that you're going to, don't you? Yeah, that makes sense. So now that's all good. So now cashbacks has been talked about. Give us a quick spiel. What is a cashback, and where do you see the future of cashbacks when it comes to mortgage broking?
Yeah, sure. So cashbacks have been a part of the mortgage lending landscape for quite a while now, and it's a way for lenders to actually increase their market share. I mentioned before that the big four banks, the NAB, CBA, Westpac, and ANZ control or have 90% market share of mortgage lending in Australia. And so we have what we call a second tier of lending in Australia. Second tier lenders, your smaller lenders, smaller, for example, they might be building societies that also offer mortgage lending. A way for them to compete in the market was to offer a cashback, to entice customers to refinance across to them. It'd be a nominal amount, 2,000 to 4,000. It got as high as up to 6,000 for some lenders, all driven by competition to try and get that market share. And this has been a big part of the refinancing landscape for the last 12 to 18 months because, it was all about refinancing. The property market was coming off, values were coming off. There was more refinances in the market than purchases. And so every man and his dog, if I can call it that, was putting out a cashback offer, even like the big four as well, and quite handsome. And some, if you had multiple properties, I've heard of borrowers coming away with $16,000 in cashback. So it's quite an enticing, little bit of cream on top for you to make that decision.
Why do I feel there's a but coming?
But
there it is.
What you often find with lenders that are predominantly chasing those cashback refinances is it may, and it often does, blows out what we call the service level times for assessment of that application. So if you need an application to refinance quickly, you might be needing it to actually release equity for another purchase of a home, or you have a simultaneous settlement that you're trying to line up as well. It can cause problems in terms of the delay.
Definitely.
Because what happens is the bank will say, we've got this great cashback. They get swamped with volume. They don't have enough staff to actually, cope with all that additional volume. They end up working weekends, the poor guys. They slip boxes of pizza under a locked door and, go for it. It just creates a bit of a mess. So as a mortgage broker, I had that conversation with the clients. Do you really need the cashback? Is it just an added bonus? But there are better options often in the market, maybe even a lower rate without the cashback. So, and look, cashbacks are starting to reduce off the market. The lenders, the big four, have started to actually pull their cashback offers. And this is due to the lenders have actually made some pretty good money over the last few years in that low rate interest rate environment, particularly with those fixed rate mortgages. Now that they're coming off, their margins are not as great as they used to be. So it's not as profitable for them to keep on offering these cashbacks. And so that's hence why they've all started to pull back from that. And the lenders are looking at the market itself. We'll probably switch that pendulum towards more of a purchaser's market.
Okay. So despite the banks making $5 billion in profit each over the last 6 months, they're going to try and preserve that by reducing clawbacks. Is that correct?
Yeah.
Joys. Got to love the systems, don't you? So, look, it sounds like if cashback is something that's important to you, you need to act really quickly because they are ending. But if it's not, then there's plenty of options. And sometimes, not always, but sometimes the bank with the best cashback may not have the best rates.
That's right, exactly. Best rate or best features for the loan as well.
Correct,
it's all good and well getting a $3,000 cashback, but if the internet banking service is back in the Stone Ages and you're used to having that with your current lender, you're going to notice there'll be a noticeable difference there for you. So
that's true.
We guide you through that process.
Excellent stuff. No, that's good. And if you guys have watching this got any questions, please let us know in the chat. And we'd be more than happy to answer those. But so let's talk about the refinancing process, because I think the really important thing that we want to highlight is that when it comes to a refinancing process, The actual application is about, even on this list, is step 6. And there's probably a few more that we haven't included here. So if myself or someone watching this webinar says, I've got this loan, I've got a very high rate, you mentioned your client beforehand, where you got the reduction there. What is the process that you go through to ensure that that you're getting the best outcome for your clients?
Yeah, sure. So look, the first thing you should always consider when looking at refinancing is go back to your current lender and see if they can, we call it sharpening the pencil on the rate. So see what they can do. Because often what you'll find is your interest rate is increased, obviously incrementally over the last 12 months. But you might go onto a website and see what current rates that lender is offering to new to bank customers. And you'll see there's often, there's a variance there. So go to your original lender or who you're currently with now and say, hey, Mr. Lender, I see that you're offering 5.24 to new to bank business, but you've currently got me on a rate of 6.14.
Yep.
How about, you come to the party and see what you can do to help me match that rate.
Yep.
Failing that, if that's the case, what you do is you come to us, book an appointment with us. We'll look at your options for you. Yeah. And then, because there's a cost involved, obviously, with refinancing. Not just
a financial one, but it's more the time
it's
and
the
getting
time,
the paperwork
that's right.
and all that kind of stuff. But even just taking a step back, like I've certainly had clients, and I'm sure you have too, that they've gone to their bank and gone, pretty please, can you give me your best rate? Yeah. And the bank goes, no. We know the questions to ask and how to phrase it. Yeah. And I remember one client about 6 months ago that asked their bank for a better rate, got told no. We went back to them a week later and said, give us a better rate. And we got, I think it was 1.78% off. So similar to the scenario you're talking about. So if your bank says no first, come to us and, we might get a better rate. And, and like the client you mentioned, that took 15 minutes to get that much sharper rate, didn't it?
That's right, exactly. And, the banks are relying on your lack of knowledge, unfortunately, as a consumer. Yep. And you're right, knowing the right questions to ask and to play a bit of hardball with them, it doesn't hurt. And all you can ask, is the question, Yes. You have to ask, though. Yes. You can't assume that the bank is going to look after your best interests. Yep. And often what we find with clients that have been with the bank for a long time, there's that misguided sense of loyalty.
Yes.
Unfortunately, and thinking that the bank, the
loyalty tax, we call that, don't we?
Correct. Yes. That's right. Look, the bank has looked after me previously and they helped me get that car loan as well or what have you and made it very easy for me. But they don't really look after their back book, or what we call the back book. Okay. Their existing clients. No. It's not in their interest to do that because they're going to miss out on making money off you.
Even though what you said before, like that they offer a better rate to new customers than existing customers, says everything that you need to know about how the system works and why it is important to, who was the founder of Aussie Home Loans? John Simmons. Yeah, keeping the bastards honest. I think it was his catchphrase. Yeah. You need to keep them honest to ensure that you are getting the best rate. And how often should you be going back to your bank to ask for a better rate?
You should be reviewing your mortgage on a yearly basis, as a minimum. Be careful not to fall into that trap of, looking every 3 months or 6 months kind of thing. Because, and what a lot of borrowers fall into the trap as well is doing their research themselves online. This can particularly have a credit hit on your credit report.
Yes. Yeah. Which makes it harder. Yeah. And I've seen the online comments about more when cashbacks were prevalent a year or two ago. Refinancing every 3 to 6 months, but then the credit score when they do that is completely shot to pieces and they can't do anything for a very long period of time. So it is important not to over-service, isn't it?
Yeah, that's right. Exactly. But at a bare minimum, on a 12-month basis, just review it. We can do that pricing. It means that you may not have to refinance, but you can get those cheaper rates.
So we've gone to the bank, we've asked for the best rate, and they've come back. Sometimes they come back with a great offer. Sometimes they come back with an absolutely insulting offer. What's the next step to go through?
Okay, so the next step is we just need to look at your borrowing capacity as well. So it may have been 2-3 years ago, even longer than that, when you first applied for that loan. Circumstances change, in your personal life. You may have, changed career. You may be earning more income than you were previously, or maybe a bit less. You may have additional debts that weren't there when you took out the original loan. So we need to look at the whole picture in terms of what your current debt exposure is, taking into account your mortgage, if there are any personal loans. Afterpay is a real topical.
Yes.
A lot of people have gotten used to, particularly through COVID, we're all stuck at home doing shopping online, wanting to buy things. And then, it sounds good at the time, spreading that commitment over, 4 monthly repayments, but then some people, unfortunately, their spending gets out of control and they have a number of these facilities going all at the same time. That does, reduce your overall borrowing capacity.
Definitely. Yeah. And I think we're even borrowing capacity with the high interest rate environment that we're in. Like, I was confident saying to clients 2 years ago when interest rates were in the two that, if you're single, no dependents, no debt, you could borrow 6 times your income. So if you earn 100 grand, it means you could borrow up to 600,000 pretty comfortably. Now it's probably around 5 and a quarter,
even maybe potentially less
than that. So even if nothing's changed in your circumstances, your borrowing capacity, which is the maximum you can borrow, has decreased from 600,000 down to say 500,000 in that situation, before we even talk about the cost of living or changes in your personal situation.
Yeah, definitely. And another thing to consider as well when we look at your borrowing capacity is you may have a credit card that you don't even use, and we've had borrowers in just recently had a $15,000 credit limit with a nil balance month to month. But that reduced their overall borrowing capacity by, I think it was about 50,000.
Yep. Help debt for me is, I know a couple that's popped up, because help debt's one of those weird debts where it doesn't matter if you've got a $5,000 help debt or a $150,000 help debt, it impacts your borrowing capacity the same. So we had one client that cleared their $5,000 help debt and freed up they could borrow an extra 60 grand, which enabled them to complete the refinance we were looking to do. So definitely all those little things. Again, before you act on those things though, make sure you're speaking to a broker or a financial planner about your options there before locking yourself into some of those paths. So reviewing property borrowing capacity, the next step is a property valuation, which is quite topical at the moment. Can you explain more?
Yeah, thank you, Chris. You stole the words right out of my mouth. It is quite topical in terms of, we're all aware, I think everyone as a property owner or potential property owner is aware of what's happened in the property market over the last, 2 years coming out of COVID. Where properties have taken a bit of a reduction. We're actually starting to see that now. In the last couple of weeks, I've had 2 property valuations that have come in quite significantly lower than the anticipation by the borrower themselves or what data we have available to us. So, for example, I had one borrower had estimated their property to be worth $850,000. The valuation was done just the other day. It's come back at $750,000. So that's quite a hit. So that's then going to limit their plans and what they were planning to do with refinancing and releasing some equity for a further property purchase.
And that's really important, especially for when you are refinancing. If you did buy in the last couple of years, whether it's under the first home loan deposit scheme with a 5% deposit, now the first home guarantee, or whether you paid lender's mortgage insurance, that poses a bit of a problem if you're looking to refinance now, doesn't it?
It certainly does. And we had a similar example where the valuation came in considerably lower than the anticipated from the borrower, and unfortunately, in order to refi, we'd need to be in lender's mortgage insurance territory. So it negates the whole point of refinancing if you're then going to have to pay a lender's mortgage insurance cost.
Correct. So just to take a step back on that, so you can if you've got 20% equity in your property, you can refinance without paying lender's mortgage insurance. If you've got less than 20% equity in your property, you can technically refinance, but you've got to pay lender's mortgage insurance. Again, lender's mortgage insurance protects the banks. It doesn't protect you in the event that you can't meet your repayment. So, like I said, technically you can do it, but I haven't seen a scenario where it actually makes sense to do that.
That's right, exactly. And the case in point with my client that it was $100,000 less. Yes, they could refinance and go up to a 95% LMI or LVR, but I would advise strongly against that in the current environment anyway.
Correct.
And he was, that makes sense. So he's going to reduce his refinance amount, get the cash that he needs right now, and maybe revisit the situation in 12 months' time.
And to put that in practically speaking, like a 95% loan to value ratio would trigger lender's mortgage insurance, I'm guessing about 20 grand.
That's right. Yeah. So, if you're looking at refinancing, it's going to take you X amount of years to actually make up that difference in terms of, even if it's a lower rate, you won't actually, be ahead for a number of years.
Correct. And that's actually really important because when we say, reducing your interest rate by 1% or the case 1.5% can save you over 100 grand over 30 years, that lender's mortgage insurance hit is probably still not worthwhile, is it?
Yeah, that's right.
Because, and like, for example, those two clients that you have did have a negative or an unfavorable valuation, I always say it's a case of it's not a no, it's a not yet.
Yes. Yeah.
And therefore, could be 6 months, especially if rates do turn quickly. And if rates turn, I think property prices are going to go flying. That could mean it's maybe a no now. There could be a yes in 6 to 12 months. They could get that favourable valuation again.
Yeah, definitely.
Excellent stuff. So, and then so there's still a couple of steps: credit checks and analyse bank statements. Thankfully, we've got software that can do all that just to make that process easier. But you can see there's a lot of work that needs to be done before we actually go do the hard part of submitting an actual application, isn't there?
Oh, definitely. And we need, as a mortgage broker, we need to undertake our due diligence, if you can call it that, in terms of our borrower's current situation, looking at their total debt exposure, as we previously talked about. You've just touched on, looking at credit reports as well. That's a really important part of what we need to look at, because unfortunately sometimes borrowers may have an old telco debt, for example. Thought that it was paid out, or maybe if you're a single borrower and it was a flatmate or someone who had the phone in their name for a shared rental. These things can come back to haunt you when you apply for a mortgage. So we undertake as much due diligence as we can to make sure that we're presenting you in the best light possible to the lender of choice, the lender of the day when we lodge that application, because rest assured they will look under every stone as well when they do their assessment of the application.
Yes.
In mortgage lending in Australia, it's highly regulated. We have the National Consumer Credit Protection Act, which ensures that we're not recommending you towards a product that at some point, unfortunately, you would fall into hardship and can't afford to repay. So we need to do everything possible within our with what's available to us to make sure that it gets, as I said, gets the a higher chance of approval from the lender.
Indeed. So if you've got any questions, let us know in the chat. If you are having some issues with the chat, hit the refresh button, and that should enable you to leave any comments. If you've got any questions or if there's anything that's jumping out to you, let us know. We would love to hear from you. So, okay, so let's move on. We've talked a lot about refinancing and getting out of jail, but we did want to talk about a bit broader about some options in regards to property and there's, because obviously it's not just refinancing that you look at purchases as well, and people are still buying a lot less than what were a couple of years ago, but people are still buying. So tell us, is it a great opportunity to buy right now?
Yeah, look, I firmly believe that it is, but with that caveat that you have to do your research.
Yes.
You have to go in with eyes wide open when you're
Mm-hmm.
looking at any kind of property, essentially. So there will always be a good value in properties, obviously in certain areas as
Mm-hmm.
well. So again, doing your research. But when we did see those values have come off a bit, if you've got the means to be able to go and buy property now, and can do it comfortably in terms of loan affordability, etc., what we've discussed now, just before,
Yep.
then a good time.
Because at the end of the day, as the cliche goes, you don't make money when you sell, you make money when you buy. And, we talked about mortgage prisoners and the fact that their property has come down in value. But for those who don't have a property or looking to buy another one or upgrade or whatever it might be, that actually presents an opportunity, because properties that were worth, say, 700,000 a year or two ago are now worth 600 to 650. So you've already saved yourself 50 to 100 grand. Now, in comparison to if you bought 2 years ago.
Oh, definitely, because we're at the height of the pandemic, and there are a lot of people who are trying to escape the cities, and regionals are a case in point. We look at the Greater Geelong area, for example.
Yes.
We've seen quite phenomenal growth.
That's put it nicely. Yes.
Yeah, that's right. But it has started to level off in some areas as well,
Definitely.
just as you say. So, where those prices were maybe a bit highly elevated, we have seen a bit of a correction there.
Yep.
And you're right. It's you make money. When you buy, not when you sell.
Because at the end of the day, like, the fundamentals are still strong. Yes, interest rates are high, and yes, that is potentially going to cause some pain. But it is causing some pain now, but it could cause further pain over the next 6, 12, 24 months. Who knows? But the fact remains, if we look at basic economics, supply and demand, there's still nowhere near enough supply. And with immigration still high, there was a report recently that we've immigrated another 400,000 people over the last 12 months. I know a lot of them are New Zealanders is trying to escape New Zealand and all heading to Queensland by reports, but not to mention half of Victoria going to Queensland as well. But, when immigration, i.e. demand, is still high and there's not enough supply, we're just not building enough houses.
Yeah.
Economics 101 suggests that that's going to push prices up.
Oh, definitely. I mean, there's on any given year, there's a shortage of 25,000 homes in Australia year on year. And the immigration factor has a considerable part to do with that, and that's why the government has opened up the borders again, because there is also a lack of skilled workers in this country.
There is.
And that's a huge contributing factor. Hence, why allowing more back into the country. There's overseas student component as well. So
definitely.
These are all having those pressures on the rental market, which is front in mind for a lot of people.
Yeah.
The only way that you can, reduce those costs is to have more supply, and hence, having more properties available.
But unfortunately, supply is not going to it's not going to correct itself, especially while builders are collapsing as we speak, especially in Victoria as well, which is certainly adding to that problem as well, isn't it?
Definitely, and we've seen it's been front of the headlines for quite a while, probably the last 12 months, and it seemed like every week there was another builder, unfortunately, going under, and there's probably more of those, what you would class as smaller boutique kind of builders, in my opinion. And that has had that knock-on effect in terms of supply of land, because developers are thinking, hey, I don't want to, rush out and, release 40 or 50 blocks to the market if they're just going to sit there.
Yes.
Because that will eventually have that impact on values as well.
Yeah, it was already slowing down the sale of blocks of land before 6-12 months ago, and that is now definitely exacerbated, that's for sure. So we are going to talk about building in a moment. I will come back to that one, and I think the key, but one thing I would want to say is, or two things really. Firstly, when we've talked about supplies, and we still supply and demand, and we still think the fundamentals are still strong, but when rates go down, which we said may happen in the next 6 to 12 months, that's what we predict. That's going to really push up prices because all of a sudden people can borrow more, talking about borrowing capacity, people get out of mortgage prison and able to refinance or upgrade, whatever it might be, buy the next property. So if you can get in before that wave occurs in the next 6, 12, 18 months, whatever that might be, and there's a lot of data saying that that's starting right now, you could be getting ahead of what could be another good wave of pushing property prices up.
Yeah,
could be.
And it's always hard to predict. It's like interest rates, isn't it? It's always hard to predict what is the bottom of the market. But again, it's basically you have to actually, what is right for you and your own personal circumstances. Getting in now, you may have a premium of higher rates for the short to medium term, but you will be better placed when those rates start to reduce. If we do head into tougher economic times, and there is a need for the RBA to cut rates, you will be better placed, and you'll have an equity position that will continue to grow.
Definitely, and I think you hit a really good point there. That we can talk about the economics and where we think property is going to go, but it's got to work for you personally. And rushing out into a property that's not right for you, whether it's location, timing, price, whatever it might be, no matter what the fundamentals or what's happening behind it, it's still 9 times out of 10 not a good decision.
Yeah, that's right. FOMO.
FOMO, that's it. Yeah, that's it.
Catchphrase of the last few years, particularly in a bubbly property market. Yes. Everyone had that fear of missing out. Low interest rates. Whether we get to that again, I don't think that we will. Potentially, I don't know. I mean, it would
take a big crisis to get another crisis.
That's right. And to be honest, every government in the world is pretty much in debt.
Yes.
So I don't know where they're going to, unless they had to print money again, to throw at a problem like COVID again.
Yep.
So I think people are more realistic now. Like I said, the 12 months, the last 12 months and constant rate rises has been a big wake-up call for a lot of people, or just make them realise, hey, this is changing, but how can I find a way through, still potentially get that property, but don't make the wrong decision and buy an overinflated property.
Correct. Yeah. No, that's very good advice there. And I think that final point there, quality is key, because I think if we look over the last 2-3 years in particular, but probably even 20 to 30 years more broadly, you just had to have a property to make money. Maybe not in Perth or far north Queensland historically, although certainly Perth has done well the last couple of years. Finally. But I think going forward, quality, I think find that research that you mentioned and that quality is really going to be important. Can you touch on what makes, particularly if we focus on purely an investment property, what makes a quality property investment?
Yeah. And quality should always be a determining factor over speculation. And we've known that now. We can see that. We've always known that, but we can see the result of the last couple of years and those properties that were highly inflated due to a speculation or speculative environment. So in terms of investment property, you need to look at one of the key things with investment property is looking at the actual rental yield. Is it getting good market rates for rentals? And that's a big key factor as well. Capital improvement is always obviously a considering factor, but rental yield is definitely up there.
And whether that rental yield is sustainable over the long term. Like there was some great rental years 5-10 years ago in mining towns, but now that the mines have left, they've all collapsed. So whether that is sustainable and able to continue going forward.
Location,
Definitely.
if I can be so
yes.
catchphrasy. But looking at investment, where do people want to live? People want to live closer to where they're at work. They don't want to do the long commute. They want to have access to jobs, good public transport, good schools for their children as well. These are all the things that need to be considered.
And even that location, you mentioned close to work, but now one of the big changes obviously with COVID is that a lot of us are now working from home. So maybe that is not as a prevailing factor, like location previously may have been close to work. I think that's still important, but now it could be, well, I can work from home and, be 10 minutes from the beach, if we use Victoria rather than if you worked in Melbourne, being Geelong, Warrnambool, Torquay, whatever it might be. that could be a good option too from that lifestyle perspective.
Yeah, definitely.
And I think and to use another cliche as well, it's land that goes up in value, not the actual building itself.
Yeah,
so
that's right.
I think particularly if you are looking, again, if you can get, especially if blocks getting smaller and smaller, if you're able to secure some land rather than being a high rise or anything like that, I think that's going to work for you long term. But if you have any questions on that or any thoughts on that, please let us know in the comments below. So, but very quickly, first home buyers. Now, there was some changes with the first home guarantee. For those who are not aware, what is the first home guarantee and what are some of those changes that have come in?
Yeah, sure. So the first home guarantee was launched by the federal government 2 or so years ago now, and federal government obviously in the middle of high price environment in property and realising is getting harder and harder for borrowers to even save for a deposit, and even high income earners of earning $100,000 a year and having to still pay rent and save money for a deposit, finding it very difficult. So the first home guarantee allows borrowers to get into the market with a minimum of a deposit as low as 5%.
Yep.
And effectively, prior to the guarantee, you would need to pay lender's mortgage insurance. We mentioned that. So
Yes.
anything, a loan to value ratio above 80%, you need to pay that premium. So this enables borrowers to get into the market. They don't need to pay lender's mortgage insurance. The government is effectively guaranteeing the loan up to a maximum 15%.
Yep.
So it's significant savings for borrowers, and they're not having to factor in, depending on the price of the property, anywhere between 10 and 20,000 in lender's mortgage insurance.
Yeah, that's pretty significant. So, and yeah, like I said, a 5% deposit rather than a 20% deposit can save you years when it comes to getting into the property market.
Yeah, and previously it was limited just to generally single applicants.
Yep.
Or it was a little bit limiting. And look, the government in the budget this year announced that they were going to expand the scheme to enable borrowers. You may have even held a property prior or older than 10 years ago. You can now qualify for the scheme as well. It could be two friends that are buying a property together as well. So that's really helpful because a lot of younger borrowers have found that they potentially just can't do this on their own,
Correct, and it's the definition of joint that's, I think, a big game changer, because usually it was your partner, de facto, married, whatever it might be, was counted as joint, and that's all you can do. But now you can do friends, you can buy with the parents, you can buy with a sibling. That opens up quite a few different options as well. And particularly the permanent resident one as well. Again, with my New Zealand wife and plenty of Kiwis coming over, usually that was limited to just citizens that were able to access this scheme, but now permanent residents are able to access the scheme as well, which I think particularly for a few Kiwis or people coming overseas, that really opens up some options as well.
Yeah, definitely. There's 35,000 spots available year on year. There's 32 participating lenders in the space that are aligned with the scheme, and so we can assist you if you've got that minimum 5% deposit. You're looking at your borrowing capacity and potentially get you into the market sooner than you would have thought, because it takes on average about 7 years to get a 20% deposit.
That's a long time.
That is a
Without
long time.
support, that is a very long time.
And if you look back to what property values were 7 years ago to where they are now, unfortunately you're going to be constantly behind in terms of trying to get into the market.
Exactly right. So look, anything you can do to get your foot in the market that suits your needs, then happy days, away we go.
Stamp duty is also something to be considered as well. So first home buyers. So a lot of the state and federal governments, their own state revenue office has stamp duty concessions, or for example in New South Wales, as of the 1st of July, you can buy a property up to 800,000 and pay no stamp duty. In Victoria, it's 600,000. as in everything, these are always under review. So, the government of the day will look at it and review, looking at property values. Where are they heading? Do they need to make any small adjustments as well? So we'll do that research for you as part of the application process.
Yep. And it's really interesting to see the changes now and going forward, because you mentioned Victoria, 600,000, that limit's been in place since about 2014 because Victoria needs the money for, I'll leave the politics out of that one, but you mentioned South Australia, I believe, going up to 800,000. That's a recent change. It'll be really interesting to see how these limits change going forward. Especially a lot of that stamp duty one is controlled by state budgets, state government, rather than the federal government or federal authority, that first home guarantee.
That's right. And look, the broad statement was made as part of the budget on budget night, and like everything government, that sometimes the wheels turn slowly. So we're actually waiting to see the actual the act and the finer details. So often broad statements are made at as part of a budget or a part of the political cycle from parties gearing up for an election. So often the devil is in the detail, but we'll help guide you through that.
Sounds good. Speaking of guiding you through it, like I said, this is pretty much close to the end of our presentation, but if you did want to hear more, go to the website on the screen, masteryourmoneynow.com.au /get started. You can book in directly with Shane, who's our mortgage broker, or you can book in one of our financial planners, myself, Patrick, or Sock, who can discuss your options. But when someone books into you, that first meeting is complimentary. Shane, what should they expect?
That first meeting is really a fact-find mission, to find out what your current situation is, what are your goals and objectives. We need to get a full understanding of what you're looking to do. And then that will then drive the conversation further in terms of what information, we'd need in support of an actual application to a lender. But there is quite a process that we do follow, and we are obligated under our licensing requirements to follow certain guidelines. So, we will outline the actual application process for you right from day one. So you're not, getting requests for information and think, well, Shane didn't discuss this with me. We follow a set process.
So find out about you, what's important to you, because not all financial planning advice or mortgage broking is it's not a cookie cutter solution. There's so many quirks and balances, like we've discussed during this webinar. Find out what's important to you and then make a solution that fits that.
Yeah, definitely. I mentioned that I've got access to 50 different lenders, and on my lending panel, when you scale that up in terms of actual loan products, I do a search and it'll come up with 2,500 different loan products. So we need to actually have that full conversation and discussion and fact find with you to make sure that we're matching you with the right product that ideally meets all of your requirements and objectives. There's no point, for example, getting you an offset account if you've got no funds to put in that offset account.
And pay the high rate.
And pay the high rate and annual fees as well.
Makes sense. So book in a chat. We've just put the link in the comments as well, and we can go from there. But thank you very much for those who have joined. Greatly appreciate it. I think we touched on building, and I'm really excited for this, our next webinar with builders advocate Rebecca Hall of Nine Dots on the topic of, is it safe to build a house in 2023, particularly with the building collapsing and all those kind of things. I think that's a really topical one. We've talked about it today, grabbing what I think is one of the best experts on this topic in Victoria, if not Australia, with Rebecca Hall, is going to be really good. I think, and a lot of people have heard of what a buyer's advocate is. Not many people are aware that there are builders advocates as well. And Rebecca's one of the best in the business, and I'm really excited about that one. And we'll put that link on Eventbrite in the chat as well. But again, thank you so much for joining in. We really appreciate your time as always. And if you do have any questions, whether you're on the stream now or whether you're watching this later on. Again, make sure if you gained anything out of us, let us know in the comments. Give us a like, subscribe, and follow us on our social media links as well. We post plenty of content on there. We do believe in educating you about your options and making sure if we can find a way that you can achieve your tomorrow financially, then that's what we're here for. So again, thank you, Shane, for your time.
Thank you, Chris. It's
And
been a pleasure.
thank you again for watching. And we hope to cross paths in the future.
Thank you.
Bye for now.
Bye.